This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and MOSH Don are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome, everybody, to Avoiding the Crowd with Maj Don. I'm the producer of the show, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And we're really excited to bring to you the next episode of this podcast. And I'm going to introduce to you your host, Maj Don. Maj, what are you doing, man? What's going on?
Bobby, hey, Arham, how you doing? Doing good, Bobby.
Well, Maj, you got to introduce the guest. I
sorry. Well,
I pump you up, and then you pump him up. You
change every other podcast.
No, I do not. We keep with this. We're cookie cutter, baby. Come on now.
We got Arham Khan here, professional investor. I don't know. I'll let Arham give his own description of himself soon. But I met Arham. Maybe through Geo, but also actually one of our subscribers at on Geo, Jerry Katarina, called me up one day and said, "Hey, you got to meet this." He knew I was coming to a LD conference, and he goes, "You got to meet this Arham Khan guy." You're in LA too, Arham, or California, as is Jerry, and so this is maybe 3 years ago or so. And then I met Arham there, and we started chatting, and he's all about stocks, and I'm glad we hooked up. We've done some work together, and he's helped Geo along the way with some articles. So, Arham, why don't you tell us about yourself instead of me doing it for you and getting it all wrong?
Yeah, sure. My name's Arham Khan. I think I'm one of the younger guys in the microcap space in the investing world. At least, actively putting my research out there. Basically got my start at LD Micro. My last year in university, I went to one of these conferences and I just fell in love with it. Saw like 30 CEOs just give presentations back to back. And after that, everything that I had to do in school was a breeze because I just saw these guys do it professionally. So took that on and I really wanted to do this full time. So I started doing it, but I worked some jobs along the way. Worked at a private equity advisory firm, which sucked. It was horrible. Don't want to say their names, but the place was dog shit. And then after that, went to a bank, a Chinese bank, and it was pretty cool. But it was not what I wanted to do. I just worked at a bank, did commercial real estate. But I was doing all this stuff on the side the whole time, researching, putting out my research, took my vacation days and went to LD Micro, got my name out. And then in November of 2020, I left my job at the bank. And I wanted to do this full time, and I wanted to raise some capital to start a fund. About a week or two after I quit, I got in touch with a hedge fund in Canada who saw my research, and they said, "Hey, why don't you come work for us? We'll do like a project-based kind of thing. You write the report, we'll pay you for the research." So I've been doing that for a couple months now. So it works out well. That's I get some cool professional experience that I would have never gotten because I basically left corporate America, right? But then I got into the hedge fund business in this way. So I kind of skipped a couple of years in that regard. So I'm doing that, and it's a lot of fun. It's a lot of hard work, but alongside that, I'm actually I'm raising capital, put together a bunch of research, and then that's the goal. Hopefully, that's the only thing I do in a short amount of time.
Great. So actually, you would attended the LD MicroCap conference. How did you learn about the conference originally?
It was one of those. I was in the endowment thing that the school had. We had like an endowment. They actually had like a $65 million endowment, and they gave 63 of it to Goldman Sachs, and then they gave $2 million of it to students. So I got into that. I had to like apply and everything, and then they had things that just popped around all the time. Hey, go to this, beef up your resume. And at the time, I had nothing on my resume. I was a deadbeat stoner for 4 years. But that's the first thing I went to, and I knew this is what I wanted to do. And then when I saw the actual business of it, and I learned the business of it, which by the way you don't really see, even if you're a top student. You go to Goldman Sachs and do something for 2 years. You need a couple of years before you see some of these sides of the business. And then at MicroCap, all these companies are very approachable, right? So yeah, it was just one of those things that the endowment program was shooting out there. Hey, go to this, go to that. I guess LD Micro wanted a couple of students to be at the conference. I said, all right, let's go. And I went there, and then that was that. Really, that LD Micro was really big for me because that's where I met everybody. Met a lot of people, and Chris kind of really put me on as well. He's been awesome for me.
So were you actually helping the endowment find stock ideas and manage?
Yeah, we were managing the money. We had about $1 million, and then it was very. We had a good amount of autonomy in what we did, but we had to actually write the report and write the research before we were able to do it, and then get grilled by a board. Our board was really phenomenal. I thought, we had some former hedge fund guys. We had a 20 billion mutual fund manager. So yeah, we found stocks. I put a couple. Well, the team put a couple in, and I put specifically myself. I put Square and Alteryx, which had both had gone on to do like 500%. Square, I mean, Alteryx kind of pulled back a little bit, but they were good inputs there. And
were they did they have any types of requirements of how MicroCaps? Could you go to nanocaps?
No. At the endowment, they wanted us to stick. Our universe was the Russell 3000 and anything over 1 billion in market cap.
So the LD was your kind of first experience into that whole kind of.
Oh yeah, absolutely. I thought I was never going to touch microcaps. I had so much success in large cap. Well, they were mid caps at the time. I had so much success there that I thought, all right, this is the only thing. And that was a dumb thing to think, but luckily I saw everything at LD, saw all these microcaps, and basically what I was doing with the large caps, it translated very well into what I was going to do with microcaps. It translated very well. And in fact, I did the same things, but the returns were better because oftentimes some of these things, some of the microcaps can be illiquid. They can be underdiscovered, just undervalued. Or there's this other aspect of it. If they just simply uplist, that's a catalyst in itself. And we've seen that together before with like Crescendo, right? So it translated very well, but at the time it was just all large caps.
And had you developed any kind of negative stereotype before the LD? Did you think, these are all shitty companies?
No, because I didn't. Because I just when I first went to it, I really didn't know what LD Micro was. I saw micro and I was like microchips or something, but it was actually companies. And then when I got there, I saw everything really. I saw CEOs. I was like, what the hell is going on? Like nobody else my age is talking to these guys, right? Or even being at this presentation. So I thought it was very uptight and very well done. But then when I actually looked up all these stocks of who was presenting, I was like, holy shit, these are like half a penny, 2 pennies. I was like, I'll probably never touch this. And then I saw like 50 of these back to back. Second conference I went and saw like another 50, and I was like, okay, no, this starts making sense. So I had a little bit of stigma when I saw the price of these things. I was like, all right, I'll buy 1,000 shares. That's only like $10. But over time, it started making a lot of sense.
I can attest that you live and breathe stocks. There's for a while there. I'll get a text at 2 o'clock in the morning. Oh, you are on the West Coast, by the way, so you're waking me up. Where I'm going to bed around that time, so you're good. But he'll text me some symbol or something out of the blue, or you gotta buy this. It's going down for no reason at all. Make sure you get it, and maybe even this Saturday. I'll forget by Monday. but so you definitely live and breathe this stuff, which reminds me of my youth. I'm glad you're really enjoying it and having fun with it. But what I do like about you, man, is something I always notice with you. You step in with conviction, and it isn't like wishy-washy. Hey, I like the stock. I'm going balls in, and this is why. So, which I've liked about you. So tell us all about your research process a little bit, how it works, do you have any particular areas you concentrate on, or you have a pretty wide net in terms of stocks you like? And maybe if you can help us understand what you're doing, how you guys success, maybe we'll learn from that a little bit.
Sure. Yeah. So I guess this is a good story. When I got out of school, I didn't have a job for like the first like couple months because I was so dead set on doing this that I said, screw it, there's no job that pays 50, 70K a year that I want, right? Like there's very few that go into this, and the ones that are, it's like, you do. I knew the business very well at that point, but I didn't really like some of the positions. So I tried my best to go right into this right out of college. And it was good, but it was also very knuckleheaded, but it was good. The first couple of months, I actually interned at an investment bank, and these guys were straight microcap, straight like Wolf of Wall Street, fraternity house, like Roth, but smaller, and it was like that, and it was good and bad for me because I just dived right into it. But it was great because my boss he's awesome. He's a really close friend of mine even to this day. But he would literally like go around and show companies to people, and half the time he'd be fucked up, and it was pretty dope, and it was cool to see. So one of the things that he told me in one of his like spiels was, you got to look at every industry, you got to look at every company, you got to know what's hot, and that's really what I've taken, and I've always done that. I'll look at literally anything. I don't know anything about biotechs, but I'll look at every single one of them. I'll meet with them. I knew everything about the COVID vaccines coming out months ahead because I was talking to these companies that were developing some things. I knew about a lot of these electric vehicle companies literally before they started popping off. The green, I knew about cannabis months before, things like that. You see that first in microcap. So I always met with every company. The way I source things in the beginning, really, I don't look like I have, let's say I want to put 5% of my portfolio in a high dividend company. I know that, but I'm not going to look around and search for one that just fits that puzzle. I'm going to wait till I see it. And lo and behold, one came up. It was NEWT, New Tech, paid like a 12% dividend, and that fit the box. But I didn't go out searching for it. At first, I didn't have a lot of people like contacts. Hey, look at this company. Hey, we want to show you our client. So it would literally, over the course of a year, I'd probably only buy into 2 or 3 companies at most. That was it. But I would really do I'd wait until I see them, and then I do my work on them. And so in the beginning, it was just literally what I saw. Alteryx was one of my first ones. That was because the CEO of Alteryx came and gave like a speech at my university. And I was like, oh, what the hell is Alteryx? And I looked into it, and I was like, oh my God, this is home run. Square, which was Square, I actually, back in high school, I would sell Wingstop, right? And I would charge people a little bit extra and then bring Wingstop to campus because I guess our school wanted to have meatless Mondays, right? And people didn't like that, so I brought that in. And then over time, when I started looking at investing, I looked back at Square, I was like, okay, this is another home run. And then another one of them is Wingstop. Okay, home run right there. I just told you that we sold Wingstop.
Well, so Wingstop there were a lot of short sellers in that one too, right?
Are there? I mean,
there was. You went against that grain. So that was nice. Yeah.
Yeah, that was very early. It just made a lot of. You're expanding. You got 96% of your sales is straight chicken. You can't lose, right? And then they franchised it out, and a lot of the franchisees really kept coming back and getting more franchises. That's a really good. Like I like those momentum kind of plays. Those beneath the surface momentum plays too. And then to finish off where I was saying about your question, over time now it's literally every month I get maybe every week I might have like 2 or 3 meetings. Our firm hits me up or Chris hits me up, even yourself, be like, hey, look at this company. And I'll be like, pass. I like that one. And then, and then that's really where the research process starts.
You better not pass on ours.
When we both look at something and you're like, hey, look at this, I really like it, and I co-sign on it, most of the times it really works out.
Yeah, we had I think, and by the way, so Bobby doesn't have a heart attack in the background. So you mentioned Square, Wingstop, you mentioned Alteryx, and Newt, was it any WT or any?
NewTek, I actually didn't write any research on NewTek. That was just 12% dividend I just bought.
Do you still own any of those stocks you mentioned there?
Every single one.
Okay. Now, yeah, I remember that you and I kind of hooked up, and then we started talking about Crescendo. I think was that was Altigen or Crescendo was the first one you wrote up?
Altigen.
Altigen's the cloud communication company, which is great. You very I guess you've written up 7 stocks for Geo so far, and they've all done, most of them fantastic. You got some new ones we'll be talking about, but Alteryx was interesting because that was I had owned a stock at that time. I don't know, I forget the name of the company now, but they got acquired shortly after I bought it. It wasn't the same, you know, this big data analytics kind of thing. And I think at the time Alteryx was selling at the price of sales of 20 times revenue. And then the one I got bought out for like 5 times, and I was so pissed. but then I remember you and I was trying to poke holes in the Alteryx, and I didn't really do. I couldn't even have the high valuation when I was looking at the company that I was buying. But you were actually pretty pounding that table on Alteryx a few times. I know that you were long. It had pulled back pretty hard. I think the first time it pulled back maybe was in 2017, end of 17 maybe. It might have been when the market was all pulling back. He said, "Go." You reached out to me. Hey, Maj, you got to buy this. And then it pulled down again, maybe a year and a half ago or so on earnings. And then you said, "Go on again." Both times worked well. So you were just another example. You pounded the table.
Yeah, most of these things is pretty long term to me. Hold for life, hopefully, but you obviously got to re-engage and look at it. At the time, Alteryx was doing a lot of things that some of the big tech companies are doing right now, which is selling off on no news, just valuation concerns or literally sometimes nothing. Some of it had to do with the convertible debt on the books, because the convertible debt is tradable by, and I've looked at this a lot of times, and it perplexes me every time. It's some of the easiest returns to be made, but you got to be careful. Like convertible debts trade, and they add to volatility in the stock. And then, you know, on a day where everything is down 10%, you might see your stock with the convertible down 20%. And that is a function of the convertible debt, the leverage. And on top of that, hedge funds trade this thing to arbitrage it out. So when they got options on all these things, you can sell into the pressure, execute your puts, buy back the stock at lower prices, trigger the stop losses. So that happened to Alteryx probably several times. They had a fat convertible debt back in, I think it was 17, 18. I called it the kiss of death because at that time, all the institutions were piling in. They're saying, you know, we want, you know, they're putting out the research reports, initiating coverage on Alteryx. It's already a little late. Not that they're late in the investment. I thought it was still a good stock, but they're pounding the table a little late on something that should have been discovered earlier. And that was the story there. It just sold off with no news, and there was a lot of good catalysts going on. It's a great company. Right now, the only comment I want to say is the new CEO is a little sell-side analyst oriented, where he's kind of grooming these the investment banks. That's the kind of thing that I'm seeing from him. He's not the same as the last CEO, who's more so of a visionary and like a real leader. He probably made himself $1 billion in the process, and he retired a couple months ago. So that's where the company really changed. And then COVID is affecting their salesmanship, and they're trying to figure out how to go back into the sales channel versus distributors, things like that.
Great. And you're still on the stock right now.
I own the stock, but I move around my weights. I'm not very much in Alteryx right now. I still own the stock, but I moved away the weighting substantially because I don't like. I mean, for a very long period of time, it was at least 20-30% of my portfolio up until last year in June. After COVID. After the rebound, that's when I started moving the weight away.
About 13 stocks right now. Is that right?
Sorry?
You own about 13 stocks right now. Is that right?
That is about right. That's about right. I would say about 5-6 of them make up 60-70% of my portfolio.
Okay, so you take a pretty big bet in a concentrated portion of the portfolio.
So basically, what I do is I have a universe of about 10 to 15 stocks that I really know the story of, and I've been long before and with size. For example, Wingstop, Alteryx, I'm looking at these companies all the time, but my weight is always in like, the top 3, 4 performers among these groups. And then basically if my returns are really good, like towards the end of last year, I'll start diversifying into 7, 8 of these names, and then when a pullback happens, I'll pile back into the best operators.
Okay, great. Now, do you have so you mentioned momentum earlier as a strategy you kind of like, but you've done contrarian stuff too. So are you locked into only 1 or 2 strategies, or will you look at a bunch of stuff like GARP, contrarian, momentum, restructuring? Will you look at all these kind of things, or are there things you don't look at actually? Maybe that's a better way of looking at it.
Yeah, so I'll look at everything no matter what, but I won't put out research on everything. I won't put my name behind everything, unless it's like a home run. Most of the times, the majority of the times I'm looking at growth actually, but I look at value and income very closely. I mentioned NEWT, but that's not one that I've covered. Wingstop actually started paying a dividend, but I wouldn't consider that income either. So I look at value. I'm actually looking at one right now for the firm that hired me. It's a plastics manufacturer. It's a lot more boring, but it's different. A majority of the time I look at growth. I look at special situations too. But most of the time, almost all the time, really it's growth. And then on top of that, I don't like buying stocks that are like that the all-time high was 5 years ago. Very rarely. I like buying companies that are in a short time frame near their all-time highs, right? I think if you look at every company that I've covered, I was buying or putting out research at the all-time high or very close to it.
Which is great, because I mean, a lot of the investors we talk to on the VYGVF podcast, kind of embrace momentum kind of strategy. I have, when I started investing, that's how I really started my whole approach, is finding these stocks at fresh new highs and finding out why they're at the highs. Right? I mean, there's definitely a lot of junk at the highs too, but if you can find the ones that are there for a reason, maybe. And there's this misconception now, if you're at high, you can't be undervalued. Well, yes, you can. Maybe you were more undervalued before that, but maybe sometimes the high is a confirmation of the story. Yes, that's pretty awesome, man. And it's proven to work. It works over and over again. So, especially on these restructuring stories too. Like a lot of the times I'll buy these restructuring stories early on, just when they're not near their highs yet. But once the restructure process, starts getting steam and starts doing well, it might be at its high. Then I might start piling in even more. So
yeah. No, that's not to say that the companies that aren't at all-time highs aren't doing well. Or aren't good investments. It's just a lot of times I like, look, do you take Michael Jordan out? Somebody told me this a long time ago and it made a lot of sense. Do you take Michael Jordan out after his 4th championship, or when he's averaging 35 a game, or if he's got 30 points in the 3rd quarter? Do you take him out? No, I don't think you do. So the good winners continue to win. It's just like, it's a wealth gap thing again. The rich get richer. Good performers continue to perform. It's almost a phenomenon, right? It's almost separate from investing, and it aligns very well. These are operators behind these companies, and they're doing a good job for a reason. I think honestly, if you were to actually look at the stocks that I covered, the last 12 months performance, some of these 1,000%, 500%. I think Voyager 10,000%. So I mean,
yeah. I think we were saying before we actually came on the podcast, you all your 13 stocks. Now you have a PDF here with all your research and some of your stuff. So where can people get that before I start talking about it?
Well, I have the list I'm on Twitter, right? Arham Growth Cap, ARHAM Growth Cap. I have that like as my pinned tweet, just the cover page. And I've always put out, like, I put out a tweet or something all the time, like, hey, if you want research for this company, hit me at this email. So that document is not publicly available yet. That's actually the document I'm going to take and show to funds and investors, try to raise some capital. It's like 120, 130 pages. So if anybody really wants it, you can email me, AKHAN at EDENCAP LLC.com. It's my email. You can message me on Twitter. I'm always on there. Happy to respond and send it to you. So if you want to look at that comprehensive research, happy to share that.
And do you mind if we share it with Geo members? We'll do that.
Absolutely, yeah.
We'll get it out there, yeah. So do you have any now? So in terms now, your fundamentals, you don't look at technicals at all? Are you only fundamentals, or do you?
I personally don't look at fundamentals at all. Short term, yeah.
You mean technicals?
Sorry. I don't look at technicals at all. Yeah. I'm 100,000% fundamentals.
Okay.
Technicals, I don't know anything. I'll reach out to somebody, hey, take a look at the technicals for me. But that's really only on short term, like, hey, should I buy here or not? When it comes to, do I want to put 5, 10, 20% of portfolio weight into this company? Does the price make sense? Really, I already know I'm going to buy the company. Does the price make sense to go alongside?
Have you ever done any shorting at all, or just only the long side?
No, I have shorted, like, just for fun, couple $100 here and there, nothing negligible really. I don't short. I think the only thing I really wanted to short was like a company that wanted to change the world for cigarettes, but 1% of the company was owned by insiders. I mean, come on, right? So, but no, I haven't really shorted at all. I'm long only.
Great. So I want to talk about some of your actual stocks here, and let's get into some of your picks that you like right now. And I'll just go over some of the ones you've just recently, the new ones that you've done on Geo recently. Now, again, you did really good with CXDO and Altigen. So Christian on the cloud communication side for us. Now you're talking about, I think your recent ones here were BOMH was one stock, Voyager, right? Another one. So let's talk about, and then there was it was ELA.
Yeah, ELA.
Yeah. So why don't you talk about those three stocks? What do you like about them? Help us learn about your process there and how you found them, how you the ideas originally, and let's talk shop.
Yeah. So BOMH is actually, I think, my only real loser, but that's so far. Basically, that's also the only company that I didn't buy after it's up 1,000. I didn't buy up at all-time highs. So BOMH actually is a new company. It's fresh off a reverse that happened last year. The reverse merged onto the OTC QB, and then basically they came out with, actually, I got this right here. They have it's like a pain roll-on cream thing, but basically they had a bunch of products that incorporated CB5, which is a synthetic version of CBD. Now, CBD and THC are not FDA approved components. You cannot put that in a product and market it, at least not yet. It's federally illegal. So this circumnavigates that because it's synthetic, and it has been proven to show that it affects the same endocannabinoid system. So they got a bunch of health products, right? That's what they're coming out with. And then that was fresh off the reverse. That's when the pandemic happened. They were brand new. They had retailer partnership with Tommy Bahamas, and they were online. Then the pandemic hit. So basically they were a zero sale company that did maybe a couple off million in the CB5 business. And then as the pandemic hit, I met these guys before the pandemic, and I had no idea this was coming. Literally a week before the lockdown. They've pivoted into PPE. They pivoted into face masks. They're one of the largest distributors of face masks, and they went into CVS. So they went from 0 to, I think it was 28 million in the last quarter, in less than a year. So 0 to 100 million run rate in less than a year, and that was all PPE. And that's when I started looking at it much more seriously, because it was trading under one-time sales. And growing literally like 5 digits, right? So I guess now the stock just has gone straight down since the reverse. They came out, I guess the price was too high, too many shares out. So when it got under one-time sales, then when I started looking at it, and then I put out some research, and it's all about they started sourcing these things from Vietnam. So they have very good Vietnam partnerships. One of the C-suite directors is Vietnamese and has extensive relationships there. So now they're bringing in more through Vietnam. They're bringing in coffee, they're bringing in socks, underwear, pillows. And one of the components of the face mask was the silver incorporated. They had silver in there, and it's actually has antimicrobial characteristics. Silver does, not the, and so then therefore the masks do too. So they're incorporating that into the new products, and now they got a bunch of different lines. They got coffee. I don't know if I mentioned that they got coffee coming from Vietnam, and that's all brand new. And they just reaffirmed their guidance of something around 198 to 115 million in the year, with 28 million in EBITDA. So those margins are, I mean, they're over 20% margins, and you've grown to 100 million. So that's the story there. You know, if anybody's looking at it now, I would definitely, like, I'm still buying the stock. It's not a huge weight for me yet, but it's probably like a 3% weight, but I'm buying the stock on its way down. And then if I see the bottom, I'm going to start buying more. And then when the new numbers come out, I'm going to take a really close look at that, because they went from 0 to 100 million in less than a year. Right. So.
And what's the price of stock right now?
It's like 30 cents.
35
cents.
Now, I mean, there's probably some, you know, the argument against the case would be someone saying, hey, well, look, you know, this was all about PPE. I mean, that was driving revenue. What's going to happen now coming out of PPE? So how do you counteract that? I mean, I know they have other things going on. Are we going to have to worry? Are we going to have to deal with maybe a year here, a year and a half of, you know, maybe this year and next year, maybe subpar growth as we wait for the new revenue to come and kind of like start showing better growth on the other products?
Yeah. So they got the CVS distribution right now. They got the original line of the CV5 that's now reopening back. They didn't have anything going on there because of, they only had e-commerce. So they're back in Tommy Bahamas and other specialty stores. They're back in there and online. So you got that line to come back, and then you've got pillows, socks, underwear, health products, and a whole new side of the business that's coming from Vietnam.
And those products are not in that current guidance, or were they not in that?
They're included in that guidance.
Is it part of it? Okay.
Yeah. So they're included. So that's where, like, you know, you really got to monitor this thing into the next numbers. The guidance, this was literally, I think, was it this week or last week? So the guidance is we're going to continue to do, you know, 25 million a quarter or so. And so you got to watch into the next quarter and forward where the new numbers are indeed coming from, versus what they said, you know, that it's going to come from everything.
Yeah, I think it's going to be certainly cool to watch it. And I know we had interviewed the company at Geo because of you and one of your colleagues. So, and I guess it's time to have the CEO. I interviewed him personally, right? And I think we're going to have the CEO, come and talk to our members at Geo. So we're going to, maybe if you accelerate that, make sure it happens, let's do that.
Yeah, I guess. Yeah. They're probably willing to do it as soon as possible. So
maybe next week we'll do it.
All right. Yeah.
That'd be great. Yeah, you see a lot of these companies that are in the PPE kind of focus right now. A lot of them, stocks have come down. You're going to have all these investors that were all just in it for COVID, and that's it, just for that period of time. They got to leave. There's going to be this kind of gestation period of people waiting to see how much of this revenue is going to stick, right? Move forward. So some of these companies will become value plays and not growth plays. You know, they're going to maintain a level of PPE revenue for many years, probably not grow it, right? You know, some will have different maybe solutions. They will see it increase. But what's cool about this one is that, let's say they can maintain now I don't own the stock, by the way, yet, but if they could maintain like a base level of PPE revenue, even if it falls off from its highs, of just constant cash flow, and then use that to help grow the other parts of the business, it might be pretty interesting, I'm thinking.
Yeah. I mean, it remains to be seen. It's the valuation makes sense to me, but the story still needs to come out. And we need to see it.
Yeah, cool. So let's move on to maybe ELA. And I actually met ELA at what I believe it was the LD conference a few years ago.
Okay.
They were going through some changes, which I'm sure you'll talk about now. So, and what did they do?
Yeah. So ELA is. I had a bunch of really good conversations with CEO. He's a lot like Steve Mahalo from Crescendo. Honestly, I think I haven't had a better chat with somebody who's a CEO than him. It was really good time talking to him. He owns 70% of his business, and he's been buying at the open market. And he told me he plans to sell none. So what ELA is it's two distinct segments. One half is luxury re-commerce, which is like gold chains, watches, silver, platinum, jewelry, but it's all used. It's not a pawn shop, but if you want to look for comparables, you can look at a pawn shop and be like, this is what they sell. So you go in there, you can sell your jewelry and buy other jewelry. And watches and things of that nature, coins, bullion, the whole, everything precious metal. The other half of the business, now, by the way, that's 70% of the business. 70% of the business is luxury e-commerce. They've got, I think they got 5 locations in Texas and one of those states, South Carolina or Georgia. It skips my mind. But they got 5 locations there. Own some of the real estate in those. This guy comes from a real estate background. Plus, they bought the corporate office 70% sublet. They bought it at the height of COVID, so they got it at a good price, and now it cash flows every quarter and gives them net income, along with paying off the lease, right? So plus the CEO is like half the debt too. So this guy, he's in. So they got very little debt outside of him. And then the other half of the business is very interesting. It's an ESG component. It's got it's recycling of basically IT, recycling of phones, solar panels. Take all that in, scrape out the metals, and then dispose of them. Now that's the very interesting. Let me go back to the gold. The gold is pretty stable, but it also has a lot to do with the price of metals, volatility in these prices. So he actually told me demand was actually double what it was most times of the year when that whole Reddit silver thing went off, but that really only lasted for a week. So that side of the business grew a lot over COVID because people had some extra money. They were shut down for a little while, but when they opened up, they had a record quarter of like 28 million in sales and 3 million. That quarter after the reopening was phenomenal, and the stock didn't move. And that's when I put out my research. So that's a pretty stable business, but it's volatile with the prices and the trends, and disposable income. We didn't have any new stimulus checks come out in Q4. Actually, you probably had it in the last week of Q4, or something like that. So Q4 was good, but not good as Q3, but it's good. Now, the other 30% of business is the recycling. Now, that's a decade-long runway for growth. You got solar panels that were first deployed in 2000, 2005. They got 25 years of useful life, and they got to come off. They got a lot of raw material in them. They got metals, so they got to get thrown out, but they don't get disposed of very well. I got a bunch of stuff in my report that talks about the waste internationally and in America of scrap metal that comes from things like solar panels. And plus the reseller business of phones is actually very big as well. So it's IT asset disposition and waste disposal. It's recycling these and using them again. So it's again, silver and components, metals, and then actually disposing them correctly. And the final piece of this puzzle is that side of the business. A lot of clients, it's like Amazon, Apple, they're corporate clients who need to dispose of, junkyard stuff. So these guys are located in the heart of Irving, Texas, which is like the most Fortune 500 dense company in the world. They just relocated into there. So they're very well set up to do business with these companies. The growth has been quite phenomenal. I think all segments the gold grew, I think, I don't want to say it incorrectly, but it's in there. It's like it grew substantially in the last couple of quarters. The other side of the business grew about 100%, the ESG component, and it's starting to become a large part of the business, like 30%. So that's the story there. It's
Are the margins better on that side of the business too?
Absolutely. So the margins on the actually gold is low margin, but it's good for sales. The other metals are still low margin, but I think it's something like mid-teens in the margin, whereas the ESG component is closer to something like 30%. I don't want to misstate it, but it's much higher and it's much better.
Do you think they foresee a situation where eventually that will become the recycle business will be the bigger part of the business? Do you think?
See, they're still growing the gold side of the business by opening new locations, but it's not like they're going to open 10 locations in a year. It's probably like once a year, or try to modify where it's leased, where instead of leasing it, their own real estate. So yeah, I do think that eventually that'll grow and become a large portion of the business, much more than 50%. That's what I think.
And do you have any price target on the stock at all? Oh.
Yeah, my price target's, I'll pull it up, but I think it's something like $11. So right now it's just under $5. Mm-hmm. It's been oscillating between like $4.50 and $6.50 for a little while. So I put my research out back when it was like a $5 stock. So my price target is like 11.70 something.
Excellent. And do you think there's anything that investors don't understand about the story that makes it that they did know they would maybe look to it more favorably?
Yeah, absolutely. It's the ESG component, because the gold, we know what it is. It's probably going to be like an $80 to $100 million business every year. We know what that is, and actually it could really jump if it's all tied to the underlying prices of these metals, gold, silver, platinum, etc. What people don't quite know is, and I'm pulling this up, is the IT asset disposition business and global e-waste. That's a very serious problem. I actually have a friend who worked at Walmart e-commerce, and he said he ran part of the business that was reselling phones. And over 3 years, like the growth was asinine, like over 100% each year, just because people are realizing that it's the same thing. Instead of buying a new phone, you can buy a resold phone, and it's the same thing. So that's part of it, but really it's the IT asset disposition, it's disposal, because all these things are going into junkyards, and it's a problem. There's a lot of initiatives out there, and I lay this out in my report. There's honestly so much stuff in it. This is one of the longest reports I ever wrote, and pretty comprehensive. So it's a lot of stuff that's hard to remember, and I'm trying to pull it up right here, but it's just the volumes of these data centers, for example. They got real estate where they have data centers on there, and data centers have to be replenished. Well, they're throwing all these things away. They have to be disposed correctly. So this is one of the businesses that does that. They take in literally any hardware component. Cell phones, we talked about this a lot. Desktop phones are the last things to go in this cloud revolution, where Adobe no longer has CDs anymore. It's all in the cloud. So now that was like 10 years ago. Now it's hard desktop phones that are end of their life cycle. So there's like a onslaught snowball just coming down the mountain full of this stuff that this business is going to be primed to benefit from.
Now, I recall from my conversation with the company, several years ago, were there some issues running the business? Were there a restructuring that went on here to get the business back on its footing, if I recall correctly, or am I thinking about
No, there's no issue with this business. There was an issue with no, the only restructuring was when they bought the 30% side of the business, which, if I recall, the CEO already had a huge stake in. I like this guy a lot, like me, right? But he basically, that was the restructuring part of it. The only issue that comes up is the CEO of this company was previously the CEO of another company, and that company ran into an issue with the employees. The employees became notorious for some kind of undercover crime thing that they were running through the business. So they got hit. The company obviously got fined, but the company was not complicit.
Okay, great. All right, let's move on now to you want to do we got two more here to talk about, Voyager, or we can talk, and we talked about what was it, LFMD, right?
Okay. Yeah, those are pretty quick. Not very difficult to explain. So LFMD is one of my larger positions. Yeah, I've actually been a shareholder for 2 years, and no, for 3 years now. Stocks had done like 6,000%. I actually had very little of it in the beginning, and then like we laid out what my strategy is. When I saw it starting to do really well, I piled more money in there. So LFMD is basically a healthcare business. They'll sell. They'll basically in the past they bought IP and patents and products, and then basically just marketed the shit out of it and did really well. Grew into run rates of they grew 100% on everything they had. They had a couple of health lines like dermatology products and skincare, and then they also have a PDF document downloader converter thing online called PDF Simply, and all these things grew like 100% every year, or really close to 100% every single year. And then when COVID hit, the growth went from like 80 to 100% into literally like 250%. So then they acquired a telehealth business, and then they acquired a new an ED drug and another drug. I can't recall exactly what it was. It was like a skincare line. So basically, the new story is this is the telehealth business that just launched though. So that's going to be interesting to see how that plays out. And it's already a healthcare business. Now, if you add telehealth component to it, you see the other multiples on these telehealth businesses. This is way undervalued. And on top of that, it's growing, like I already mentioned, but they're growing with two new products. The guy's bread and butter. I think the brilliance in this company is the CTO, and I know him pretty well. They were actually a client of my former boss, back when they were called Conversion Labs. So I knew these guys pretty well, and the CTO is the whole team is very, very smart. The CEO is also a director at QUBT, Quantum Computing, which is also up 1,000%. And like he's like 36, and everybody else in that business is like 60. These guys are young and smart. So the CTO of the business has a marketing background, and he's been marketing really well. So with two new lines, you can grow those two businesses. The PDF Simply is also growing. Like if I were to run down every single component of this business and say how fast it's growing, you'd be like, what the hell? So overall, the growth accelerated from like 80 to 200% to 250%. So last quarter came in at 220% growth, and then they guided for even higher growth next year. The run rate is 64 million right now, and every time they've shattered the run rate into a new higher run rate, every month they read it out, or every quarter. And the final guidance right now is 85 to 95 million for the year. So that implies a run rate of over $100 million by the end of the year. And if you look at the market cap today, I think it's under it's like 350. So it's trading under 4 times revenue. The other telehealth businesses are trading at asinine multiples, and this is growing 200%. The problem that I think the market had, the stock actually came down over 50% after the tech bust and then the recent earnings, which for the second consecutive quarter, they've had a really fat stock comp expense. So it affected the net income. That's not a perpetual expense. So the valuation right now looks very good. Into next year, becoming a $100 million company.
If you took that expense out, would they be making money, or is a better?
You're never going to see profitability in this company for a long time. Okay. With that taken out, you're going to get closer and closer, but the margins are still going to be negative.
Okay. There's plow a little money back in the business, I guess, too. Right?
Yeah, it's all into growth. And they've done it, and they've always delivered on it, and into the growth and into the investment. close to the end of midway last year, they had an external private placement by one firm that spent I think they made I don't remember, but they spent like $500,000 on due diligence alone. So I mean, this is bread and butter growth right here.
I guess so. Is it Teladoc? Would that be
that's the market leader?
The market leader, right? So they will be competing against those guys somewhat.
Yeah. But at this point, it's limited number of offerings. I actually don't know the overall telehealth business very well. I know some of it. I knew of it when I worked in the PE space. I looked at a lot of venture capital backed healthcare companies that are now coming public. So that's a very new portion of the business. But yes, that's who they're going to be competing with, trying to sign up doctors and get patients onto that platform.
Okay, great. All right, and let's move on to Voyager, which has done really well for you.
Yeah, Voyager really, I mean, in a month, already 50%. I bought this after it was already up 100x in the last year. 100x. So I met with these guys through LD Micro. Really had a good conversation with the CEO. Basically, this is a crypto broker. I was totally turned off as I was entering this meeting because I didn't want to touch crypto. But I was blown away. It was probably the best first impression I've ever had from the company. Basically, they're a crypto broker. They're directly comparable to Coinbase. They're directly comparable to a TD Ameritrade or Charles Schwab, but that's for stocks. This is for digital assets. Like, I'm so turned off by digital currency that I call them digital assets, not even like coins, just because I never want to touch it. But I'm starting to see some of the utility in this thing. By the way, I think what some people miss, and this is what I missed myself, is there's this digital asset out there called USDC, which is basically like a money market account. It's $1 per one asset, and it's pegged to the dollar. It literally stays at $1. So basically, it's just a digital 24/7 liquid dollar, and that's important because these guys pay interest on the crypto. Now, Coinbase is also doing this as well. They're starting to do this, but these guys are paying from 6 to 10% interest on assets that you hold. So that's a pretty good value proposition for people who want to move their assets onto this platform. And they've grown from 3.6 million in revenue in December to 8 point something in January to 20 million in February. So you're about to 10x sales in a couple months, basically.
Can you break down how they make the revenue, Arham, a little bit?
Okay, so the revenue comes from the bid-ask spread. The average account size is $10,000. The revenue comes from the bid-ask spread, basically, and it's as simple as that. Another part of the revenue comes from interest revenue, and this is where it gets interesting. That part of the business is very small, and it's going to remain small. It's going to grow as the company scales, but it's going to remain a small portion of the business. It's interest revenue from taking your digital assets, your Bitcoin, and all the others that you own on the platform, taking those coins, that inventory, and lending it out to banks. There's what's it called? There's a Goldman Sachs backed bank that they do business with. They lend the coins out, and then right now digital assets are very much in demand, so they're getting paid a lot in interest revenue, and then they're giving that interest revenue back to the consumer. Now, what does a bank do with your cash? They take your cash, and I worked at a bank. But this is simple. They take your cash in your money market account that pays you 0.2% interest over like 2 years, and then lend it out to the next sucker for 3% for the home that they want to own. So this operation mimics that of a commercial bank. The CEO of this company comes from E-Trade. He built E-Trade. So they're mimicking this process. So this is very going to transform, and this is some of the catalysts in this, is going to transform into debit, credit cards, ACHs and wires, sending money to your friends and things like that. They're going to bring on stocks. So that's basically the operation that they're building out. And that's why it's interesting to me, because you're going to see Goldman Sachs, you're going to see Morgan Stanley, you're going to see all these other large banks move into digital assets, and they have the money and the brains to do this. The place where I worked and the other commercial banks, they're a little slower. They don't have as much money. They don't have as much brain power. And that's not a knock on them. It's just the way they do business. They're not going to do that. Bank of America bought Merrill Lynch, and now you can go into Bank of America in any office and walk into a Merrill Lynch associate's desk because it's inside. So that's the kind of thing that I'm seeing with this company. And that's my overall thesis. At the end of the day, this is going to be sold to probably like maybe a Charles Schwab, but probably a Bank of America or another bank, because these guys are going to be late to the digital asset gold rush. But at the end of the day, right now, it's all about the land grab and the valuation. The valuation last month was something like 10 times the annualized sales. That doesn't make a lot of sense because Coinbase is about to come out at like 50 to 100x sales. So with that, there's your catalyst there. It's the arbitrage between, and this is still on the OTC, so it makes a compelling case for the valuation.
Excellent. So have you had some, you say you hold long term. Yes, so you'll definitely hold through volatility as some of your stuff's going down. Have you had any bad investments you've given up on? Yeah, so far you're just sticking with them.
No. For the long-term positions, if I put out research, okay, BOMH is the only one that's been a serious laggard. But I have not sold it. That's the only one that's been a serious laggard, but it's just more a function of the reverse. I think more so than it's about getting the name out, more so than the business performing, plus it's being new. When it comes to, I hold through the volatility no matter what. But no, I've never sold out on an idea. If I have, it's to move into a different name, but I still own the same stock. Basically, like Alteryx and Fiverr. Fiverr is the most comprehensive work I've ever done. That was actually an engagement from the hedge fund I work with. That, by the way, Fiverr, it's a large cap, and that's probably one of the best investments out there right now. But that took a big hit, and I'm still holding. It's my second largest position right now behind Voyager.
And remind people what Fiverr does, please.
Fiverr is a freelancing marketplace. It's a very long story, but quickly it's freelancers. Basically, you go on there if you want to make money. Like for example, I could go on there and be like, I will write a stock research report for you for $500, okay, or $5,000, or $5, right? And you'll go on there and you'll be like, I want somebody to write a research report for me. So you type in search stock reports, and you'll find me, and you'll find maybe other people. You'll find and then you'll basically, I set the scope. You go on there, you pay me, I do the work. There you go, we're done. So that allows me to augment my income if I have a job and I want to get more money. It allows me to leave my job and do that full time from the freelancing marketplace if I want to. What it doesn't have a solution for yet, and this is more of actually a good thing. They don't have a solution for Walt Disney to be like, we want to hire a bunch of coders. Let's go find coders. That's where we work. Upwork. That's what Upwork does. But that's more comparable to a staffing solution. I go into this in a lot of detail because this is the question I continue to get. I'm telling people this is not the same thing. Absolutely not. In fact, Fiverr has the component that they're building in now to take that market share away from Upwork. They can take Upwork's market share. Upwork can't take Fiverr's market share. They cannot, because Upwork clients spend $1 million a year. This is Walt Disney. This is Amazon or whoever. Fiverr, the average spend is, and it's growing every quarter, which is a good thing, but it's 200 something a year per person versus $1 million. So this is actually a market. This is a fragmented marketplace, and the jobs are one-off projects, right? and they can go as low as $5. And this is the real crux of the argument. For a job as low as $5, or any job, okay, so the minimum is $5. But if I want a coder and I want to hire Maj to code for me, and he's in Philadelphia, he's going to charge me $500, and that's going to pay his rent. It's going to pay his utilities. It's probably going to buy him other shit that he wants. Whereas if I go to, okay, so that's costly for me, and maybe it costs me $10,000, and I got to pay Maj $10,000 to do a whole project for me. Or I can search for the same thing and find the next guy who's charging me $20. Let's call it $500, so a fraction of the price, and he's in India, or he's in Pakistan, or he's in another country. That $5 over there is worth a lot more money to them than it's worth to us. So there's this arbitrage there with labor, and it's quite significant. And in fact, I think I don't understand. I don't know where there's a better fundamental argument for a company. Okay, because when COVID happened, okay, I have a list of top 10 freelancing geographies. Okay, a lot of these are third world countries, and that's very good for Fiverr. A lot of these are third world countries, and a lot of these third world countries have initiatives. A lot in Africa, between Nigeria and South Africa, they have a lot of initiatives to get people. All you need to get on Fiverr is an internet connection. So they have a lot of initiatives to teach people skills that they can do on a computer. So, okay, so back to that 10. So before the pandemic, there's a top 10 list. And then after the pandemic, there's another top 10 list. Not only are these geographies growing much, much faster, the top 10 list composition has changed completely to pretty much third world countries. Like you would see India and Pakistan, just the difference, and it's in there. It's in that document. The difference in there is ridiculous. Give me a second. Okay, so the top 10. Okay, I'll give you the top 3 before the pandemic. This is 2019. Top 10, top 3 fastest growing geographies: USA 78%, UK 59%, Brazil 48%, Pakistan 47%. That's the 4th. Okay. 2020, Philippines 208% growth, India 160% growth, Japan 87% growth, Australia 86% growth, and then later on in the list there's Mexico, Argentina, Pakistan still there. Pakistan went from 47% growth to 69% growth, and that's a geography that is already trying to push this into push their world economy into this industry of freelancing. I think Singapore had another very interesting case study, a bunch of interesting case studies in South Africa. No, not just Africa in itself. Ukraine was an interesting case study as well. So that's the argument there. It's the labor arbitrage, and then finally this whole business, 80 to 85% gross margins, 91% growth, and they're guiding 51% growth for next year. They've always beat those numbers. So 80% margin, and they're spending all of it on growth. But they're starting to generate EBITDA on an adjusted basis, up to 8% on an adjusted basis. So let's just call it flat. The entire business is run from literally one computer in Israel. Basically, it's one office. So the return on your assets, return on invested capital is about to be exponential in the future.
Yeah, by the way, if you're going to hire me for a program, that's your first mistake. Do not do that. Your product it's not going to work. But I'm familiar with Upwork. We use Upwork, Geo, and I've used it from some of my personal projects. So how is, again, just really quickly distill, how does Fiverr work different than Upwork? Are you putting in like on Upwork? You put a job in there. You're looking for a job. It could be a project or a full-time thing or a part-time thing, and you describe the details of your job you're looking for, and then freelancers will, on Upwork. A lot of them are India and abroad will respond that they want to work the project, and of course you have anywhere from really $5 an hour to your $200 an hour kind of job programmers there. So tell me how, again, I'm not quite understanding how Fiverr is different than that.
Okay.
So I've never used Fiverr. So.
Okay. So Upwork is basically you're gonna ask people to bid for your project, right? And Upwork is actually concentrating on reducing the $5 an hour wage labor. They want the higher wage labor. They want the coders. They want the programmers, and they want the staffing solution for a Disney or Amazon, Google. And then when you go on there, you're going to put in your resume if you're a freelancer, and you're going to bid for these projects. And it's basically now, I guess the scope of that project depends on you, the person who's putting the job there. The scope on Fiverr depends on the freelancer, and the freelancer sets the scope. The marketplace determines, the quality of this person based on reviews and things like that. So that's some of the things there, and allows, for you to augment your income. So if you want to be a full-time freelancer and you have a job background, Upwork makes a lot of sense. But if you want to be an entrepreneur and you want to set the scope of your gigs and your projects, you go on Fiverr and you're able to do that. Not to say that Upwork doesn't work. Some people use both. It's really a different kind of marketplace. And then the business aspect of it, which it serves. Again, Upwork average client spend is $1 million a year. $1 million fucking dollars a year. Fiverr, it's 200. So Fiverr is actually going to be able to, okay, and I guess you fall under this to some extent. You fall under this classification. Okay, maybe not exactly, but there's a lot more businesses that do than don't. There's a classification out there called a non-employer business, where a business does not have any employees. They're not going to be able to, not all of them are going to be able to go on to Upwork and hire a bunch of people for a determined project and pay for that expertise. Whereas in Fiverr, you really literally know the scope of the entire project as you enter it. And it's primed to take more of those non-employer businesses, which are growing in number, by the way. Some of those numbers are iffy because there's a lot of family offices and things like that probably will never use freelancer. But there's that entire classification that I think Upwork is going to miss, and Fiverr is going to be able to take advantage of. Fiverr is also building out that part of the business where they can take away market share from Upwork by basically going after businesses. They have a business platform as well, but it's negligible right now. It's brand new.
So I'm basically going on the Fiverr. I'm actually looking for something. And these kind of job descriptions are already kind of outlined for me to look through. And I could pick someone through that mechanism versus Upwork, where I'm posting my job and then they're bidding on it. So that's the basic difference there, it looks like. That's pretty cool.
That is the difference on the surface. Yes. Yes.
Yeah. Cool. Awesome.
Go on there. Check it out.
Yeah, I will, man, for sure. This has been awesome. Well, thanks so much, man. I'm glad you stopped by here and did this. We've been talking about it for a long time, and I'm glad to see you growing and finding success. And I can't wait to, get your next pick on Geo. By the way, I do own Altigen and Crescendo. They were two stocks we talked about earlier, and I'll certainly be looking at some of Arham's picks after this conversation. And we'll be talking about it on Geo, and maybe having you on again to talk more in depth about some few of these. So again, you can come to GeoInvesting at geoinvesting.com, and you can take a free trial with Geo. We have monthly memberships, biannual, annual memberships, and you can follow Geo at Twitter at GeoInvesting, and you can follow myself on Maj GeoInvesting. And you can email us at GeoInvesting at support@geoinvesting.com, or email me directly at Maj at GeoInvesting. So, so again, Arham, tell us everybody again where they can find you again.
Yeah. Hey, thanks for having me. It's really kind of a checkpoint in my career, to actually be asked to do a podcast, and that's very awesome for me. Really enjoyed it. Thanks for having me. And I could be found sort of professionally. I'm independent, but basically my work is delegated between clients. But I'm on Twitter and I'm pretty active on there, putting out some research here and there. It's Arham Growth Cap, ARHAM Growth Cap. That's my Twitter handle, and on there you can direct message me if you want any research, or you want to talk, or if you want actually to obtain the document that Maj has in front of him. You can meet me on there. Just shoot me a message, and again, my email is akham@edencapllc.com.
For full disclosure purposes, would like to add that I am a shareholder of the companies that we mentioned and talked about, all regarding my research, which include Adobe, Wingstop, Square, Alteryx, LifeMD, Altigen, Crescendo, Nova Leap Health Corp, Envela Corporation, Fiverr, Boomer Holdings, and Voyager Digital. Also would like to add that I'm not an employee of Strax, but I am a shareholder.
Excellent. Thank you, RM. Bob, you still there?
Of course I'm still here. Of course I'm still here, man. I never leave. Well, appreciate you guys. Thank you so much for doing this. And we'll all chat soon.
All right. Hey, thanks for having me on here. It was awesome.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and Majsway are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.